Hey guys, in this video, you're gonna learn exactly what price you should be willing to pay for a stock. This is the method that I've successfully used in order to achieve above average returns for the past couple years. Specifically in the last financial year, that's July 2017 to June 2018, I achieved a realized rate of return of 15.07%, while the S&P 500 returned about 12% and the ASX 500 returned about 9%. I'm going to be explaining each aspect of this formula in detail, so not only do you know how to use the formula, but you also know why you're using this formula and why some of the greatest investors in the world use similar formulas in their valuations. And not only that, I've also got a free stock analysis spreadsheet that's going to make it really easy for you guys to calculate the buy price of your businesses, so you don't have to get the calculator out. And if you're not a math whiz, it doesn't matter. You're going to be easily able to apply this in your own valuation. Towards the end, of course, as well, we're going to do a live example. I'm going to run you through an example of one of the stocks that I personally hold in my portfolio. In fact, it's my biggest position in the stock market, and I'll just run you through my thoughts as I'm breaking down each aspect of the formula with a live example. So let's jump straight into this one, and let's start off by talking about some of the things you need to do before you start to calculate the buy price of a business. When analyzing a potential investment, there are three things that you need to do before you even get to the point where you could start to calculate the buy price of a business. The first thing that you're going to do is you need to understand the business. And basically what this means is, the first point is that you've got to pick businesses that you're personally interested in, so that you're going to not be discouraged from going to the effort of learning everything about every business that you're going to be investing in, because essentially you really need to know, you need to have a full understanding of how the business operates. And by that, basically what I mean is, how do they bring in revenue? What are they spending their money on? And what is the likelihood of the risk factors that are going to impact the business over the long term? I won't stick around in this part for too long because that's not the purpose of the video, but if you're interested in learning more about the circle of competence, which is basically how I define this part of the analysis, then I'll leave a card to it up there, and I'll also leave a link to it down in the description below. I'm gonna leave links to everything in this video, everything that you could possibly need down in the description below. So after watching this video, go check out everything down there, so that you can expand your knowledge and make sure that you're getting the most out of your investments. The second thing that you need to do is you need to analyze the business's economic moat. So essentially what I mean by an economic moat is that the companies that you're investing in need to have a long-term competitive advantage that is going to ensure that they're going to be able to, one, thrive in the industry over the next 10 or 20 years, and also be able to fend off its competition in that industry so that it stays a major player in that industry and can continue to perform as it has in the past. Again, if you want to learn more about this, I suggest that you check out any of my recent individual stock analysis videos. I'll chuck a couple of them down in the description below, but essentially in all of those individual analysis videos, I break down how to assess the economic moat into a qualitative and a quantitative sense, so that you cover all of your bases and so that you are 100% confident that the businesses that you're going to be investing in have sustainable long-term business models. And the third thing that you need to do before you get to calculating the buy price of a business is that you need to assess the effectiveness of the management. And really there's two questions you want to be asking here. The first one is, how effective is the management at investing within the business? So they're taking all of the money they've got available to them, and what kind of return are they getting on those investments? And the second question is, how much risk are they assuming in order to get those returns? In other words, how much debt are they taking on, and how effective are they at managing their debt? Again, you can check out some of my individual analysis videos in order to see how I assess this component, but I also have a video of the YouTube stock portfolio dedicated to assessing the management's effectiveness that I suggest you check out. Again, linked down in the description below. And actually, if you're really interested in learning about management and you wanna take it to the next level, then I suggest you go check out the latest episode of the Young Investors podcast. I believe it's episode 12 or 13. I'll link it down in the description below so that you know exactly which one it is. But essentially, that's an hour-long podcast where myself and Brandon from the Aussie Wealth Creation YouTube channel talk all about and talk in depth about management effectiveness and what are the kind of things that we look for when assessing a management team. All right, so that brings us to looking at the intrinsic value formula. Now, before I put it on screen, it may seem a little bit intimidating to some of you if you're not great at maths, but again, don't worry. While I am in this section going to go through each aspect of it so that you could do it manually if you want to, remember I have a free stock analysis spreadsheet linked down in the description below, which is gonna make it really easy for you to do. And at the end of this video, when I go through my live example, I'll show you how to use that spreadsheet in order to calculate the buy price. So if this bit is a little bit confusing, don't worry, just hold tight towards the end, and then I'll show you how you can do it if maths isn't your strong point and you're not really interested in understanding why we use this formula and how each aspect works. But essentially, the first thing we want to do is we need to calculate the future price of a stock. So what I mean by future price is basically, obviously, we have the current stock price now, and we need to calculate where that stock price will be in 10 years' time. So how you do that is via the formula on the screen, and essentially what it is it's the earnings per share, and then we're going to times that by 1 plus the growth estimate that we're going to come up with, and I'll talk about that in a little bit. The 1 plus growth rate is to the power of 10 because we're looking 10 years out into the future, and then we're going to times that all by the PE ratio that a company will have in 10 years time. Once we have the future price, we can work backwards to today in order to calculate the current day intrinsic value, and I call that the fair value. And essentially, formula is on the screen again, and basically what it is, you take the future value and you divide it by 1.15 to the power of 10. And basically what that 1.15 to the power of 10 is, basically it means that we're targeting a 15% rate of return. And I generally target a 15% rate of return because it's high enough above the market average of about 8 to 10% that it's worth going to the effort of analyzing individual businesses. And it's not too high that you're never gonna find an investment. But for example, let's say that you wanted to target a 13% required rate of return, then that bottom bit, the bottom denominator would be 1.13 to the power of 10 instead of 1.15 to the power of 10. Now, the fair value is not the buy price, and you might be a little bit confused by that, but it kind of makes sense once we explain it. So essentially what we need to do is we need to allow for a 50% discount from the fair value, and that discount is called a margin of safety. The reason that we want to buy our stocks at a 50% discount to fair value is that because we need to allow for 1, errors in our valuation, errors in the growth rate and in the PE ratio, and we also need to allow for the fact that the business might not perform as well as it has in the past. And if we allow for both of those errors with a 50% margin of safety, it ensures that even if the company underperforms, and even if we're a little bit wrong in our valuations, we're still going to make a 15% return at minimum. Again, I have a video on margin of safety and I'll link it down in the description below. All of the links down in the description below, and I suggest you go check them out because it is important that you sort of nail all of the other aspects of valuation, of analyzing businesses, before you come to the point where you're going to be actually calculating the buy price. So in that formula, you might have noticed that there was really 2 main variables. The first one is the growth rate that the company is going to be able to achieve over the next 10 years. And the second one is the PE ratio, which is the price divided by earnings ratio that a company is going to have in 10 years time. And we need to ensure that these are as accurate as possible in order for our intrinsic valuation to be as accurate as possible. First, let's talk about the growth rate, and essentially what this comes down to is your knowledge of the business and the industry in which it operates. But as a general guide, I generally use the long-term equity growth rate that a company has achieved over the past 10 or 20 years. Assuming all of the other aspects of the business check out, meaning we understand the business, it has a wide economic moat, and management is really effective at investing within the business and also paying down their debts and managing their debts. Assuming all of that, then the long-term equity growth rate of the past will be fairly accurate in estimating the next 10 years of growth for a company. However, there are exceptions to this rule, and really the performance of the company over the next 10 years can vary greatly from the performance of the last 10 years, depending on specific circumstances tied to a specific business. So that's where understanding the business and the industry in which it operates comes in real handy, and you need to understand that. because there are certain things and certain characteristics about specific businesses that will mean that one 10-year period of growth may be vastly different from another 10-year of growth for a company. And basically, I'll show you what I mean when I go through the example at the end of the video and I talk about a cyclical business, which is a really hard one to value, and it's one that can go terribly wrong if you're not really careful and if you don't understand the business and the industry in which you're investing. And then that second variable that we need to look at and that we need to accurately estimate is the PE ratio that a company will have in 10 years' time. And essentially, the PE ratio tells us how the market values a company, and it's really tied to the future growth prospects of a company. So if you have a business that is expected to grow at a high rate over the next 10 years, it's likely that it will have a really high PE. So think of something like Amazon. It's expected to grow really, really fast over the next 10 or 20 years, which is why it has a PE ratio of above 100. And in the same way, you have something like Apple, which is not really expected to grow too quickly over the next 10 years, maybe at a 5 or 10% growth rate. It has a PE ratio of between 10 and 20. When estimating the future PE of a company, I generally just use the average PE that a company has had over the past 10 years. But again, like the growth rate, this will vary depending on the specific circumstances of each company that you're looking to invest in. For example, if we have a high growth company at the moment, over the past 10 years, their average PE might be something like 40. However, if in the next 10 years their growth is going to slow down dramatically, using a 40 PE in our valuation is just way too high. And for that reason, I generally try and stick to investing in businesses that have had really consistent growth over a really long period of time, so that their PE ratio has sort of stayed the same in the market average region for a very long time, rather than companies that are going through a high growth period of 30 or 40% growth. However, if I am going to be investing in a high growth company, I always ensure that I use a really conservative PE ratio that sort of sits around the market average of somewhere between 15 and 25, rather than using a really high PE that they probably won't have in 10 years' time. So now that I've gone through the formula and each aspect of it, let's go through a live example of Thor Industries, which is my biggest position in the stock market, and I'll show you how to use my free spreadsheet in order to calculate the buy price of a stock. If you haven't already, I suggest you click the first link in the description below to open up the spreadsheet so that you can follow along and so that you can easily understand what I'm doing when I'm going through each aspect of the spreadsheet and using it in order to calculate the buy price. But for now, let's jump over to my laptop and I'll show you a live example. Alright, so when you open up my spreadsheet, it will open up on this page, and what you're going to want to do is go over to the buy zone calculator. That is how we're going to calculate the buy price for this business, and just ignore the payback time calculator for now. I will talk about that in another video, but for now we're just going to be using the manual buy zone calculator. So over to the side here in input info, you can see that there are a couple of things that we need to input. The first is the EPS from the trailing 12 months. So if we just jump over to Yahoo Finance and we click and we go to Thor Industries, we can come down and see that their EPS for the last 12 months has been $8.14. So we'll go ahead and enter that in. The time frame that we're going to be looking over is 10 years, and I suggest that you always look over at least 10 years. The current stock price at the time of recording this is $66.83. And you will see that margin of safety is set at 50%. You can change this, however, I recommend that you leave it at 15%. And then lastly, we've got what return we want to achieve each and every year for the next 10 years. Now, I'm going to be changing this for Thor Industries because Thor Industries does in fact pay a dividend. So I'm going to assume that we're going to be able to get a 1.5% dividend, and then we're going to need 13.5% from the stock price appreciating, and overall that will add up to a 15% return each and every year for the next 10 years. The next thing you're going to need to do is come over to the data input tab, and you're going to see here it says price to earnings ratio. And essentially here you're going to need to enter in the 5-year low or the 10-year low, the 5-year high or the 10-year high, and the 5-year or 10-year average. For Thor Industries, I have inputted 10, 20, and 15. Now this is not quite the low, the high, and the average, but as I said before, depending on the specific circumstances of your businesses, you're going to want to adjust this. And generally, besides when we're going through a recession and when earnings are getting hit significantly, Thor Industries PE ratio generally bounces somewhere between 10 and 20, so I'm going to use a 15 as my average. Then the only other thing we need to do is enter in this growth estimate. Now there's also an auto buy zone calculator that will do an automatic calculation based on the long-term growth rates that you've entered in the growth tab, or that has automatically been calculated in the growth tab. However, I always recommend that you use the manual buy zone calculator because the auto buy zone calculator can often over-exaggerate the potential of a company, especially Thor Industries. 25% is way too high. I would never use a growth rate that high. So if we come over to the spreadsheet, the first thing we can see is that the 9-year average for equity growth for Thor Industries is just under 12%. So that's one number that we could use. We could also use their very, very long-term equity growth rate, which is which over the 23-year period has been just under 14%. Now, again, you want to start with the long-term equity growth rate, but it also depends on the specifics of your company. For example, with Thor Industries, over the past 10 years, their average growth rate from peak to peak, so from their peak equity in 2007, I believe it was, their peak equity in 2007 to their peak equity now in 2018, that is actually the slowest equity growth they've had in their history. And the reason for that was the GFC. We had a massive recession. We had the biggest recession we've had in 100 years, a recession that comes along every 100 years just about. And during this time, credit was really unavailable, which meant that people who were taking out loans to buy RVs, Thor Industries is an RV manufacturer if you didn't know, it made it really difficult for people to do this. So this was the worst period in their history. And as you can see from their equity growth chart over the long term, during the GFC was the only 3 years in their entire 35-year history, or over this 25-year graph, where their equity did not grow. And in fact, if we look at their equity growth from the last recession, the one before the GFC, so that is from around 2000 up until 2007, their equity growth rate was actually 20%. So when there isn't a massive credit crisis and there's no credit available, their equity continues to grow at a really high rate. So that's just something that's specific to Thor Industries, and there will be similar things that are specific to your businesses. So understanding the business is really, really important. So essentially I had the 12% growth rate, which was the equity growth over the past 10 years. Then we had 14%, which was the equity growth over the last 25 years. And then we had a 20% growth rate from 2000 to 2007, which was the cycle before the Great Recession. So what I did was I ended up taking an average of those, and I came up with a growth rate of 15%. So if I enter 15% into this white cell here, it's going to calculate the fair value and the buy price. That gives us a fair value of $140 and a buy price of $70 per share using a 15% growth rate. And as you can see, based on the fact that the stock price is currently under $70 per share, it would mean that it's currently a buy. So I hope this video helped you in calculating the buy price of your businesses. Remember, there are a ton of links in the description below for your further enjoyment and entertainment in order to expand your knowledge in this area, as calculating the buy price is just one tiny component in the overall analysis picture. If you did enjoy the video and you want to see more videos like this, I suggest that you become a subscriber, hit that subscribe button and hit that notification bell so you don't miss out on any of the future videos. Leave a comment, let me know your thoughts on this valuation method. Do you use this valuation method, or do you use a different one? But I hope you guys have a great day, and I'll see you in the next one.